In the world of finance, there exists a particular kind of theater. It's a drama played out in the glowing terminals of Wall Street, on the frantic floors of stock exchanges, and in the hushed, mahogany-paneled boardrooms of the world's most powerful corporations. The lead actors in this play are men and women of immense intellect, armed with doctorates in mathematics and physics, wielding computational tools of unimaginable power. They build models, glorious, intricate cathedrals of data with thousands of inputs, projecting earnings and cash flows and market share out to 100 decimal places. They speak a language of alphas and betas, of stochastic calculus and Monte Carlo simulations. Their spreadsheets are works of art, galaxies of interconnected cells, each one a testament to their analytical prowess. They present these models with the unshakable confidence of a high priest revealing a sacred text, a map of the future so precise, so detailed, that it feels less like a forecast and more like a memory of things to come. And this theater, this grand performance of complexity, is designed to do one thing: to convince you, and to convince themselves, that they have tamed the beast of uncertainty, that they have banished risk and reduced the messy, chaotic, and deeply human enterprise of business into a predictable, solvable equation. This is the path of the 99%. It is a path paved with the illusion of control, a siren song of precision that lures investors onto the rocks of financial ruin. Because deep in the heartland of America, in a quiet office in Omaha, Nebraska, a man who has built one of the greatest financial fortresses in human history operates on a completely different principle. Warren Buffett, the protagonist of a much quieter, much more profitable play, has watched this theater of complexity for over half a century with a knowing, grandfatherly smile. He has seen the geniuses rise and fall, the complex models built and then spectacularly implode. And while they were calibrating their algorithms, he was often making multi-billion-dollar decisions with a tool so simple, so primitive, that it seems almost insulting to the high priests of modern finance. He was using the back of a napkin. This is the great paradox of Warren Buffett. He has achieved a level of success that the most complex minds in finance can only dream of, and he has done it by relentlessly, almost brutally, simplifying the game. His thesis is not that complexity is bad, but that it is a dangerous distraction. It is a fog that obscures the few simple truths that actually determine the success or failure of a long-term investment. While others are lost in the weeds, arguing about whether fourth-quarter revenue growth will be 8.2% or 8.4%, Buffett is asking a different set of questions. Can this business raise its prices a little bit every year without losing customers? Will people still be drinking this soda or chewing this gum in 20 years? Is the management honest and capable? Can I buy this durable, cash-gushing machine for a price that gives me a massive margin of safety? These are not questions that require a supercomputer. They are questions that require deep thought, business acumen, and an unshakable discipline. They are the kinds of questions you can ponder and answer with a pen and a napkin. The costly market mistake this approach prevents is perhaps the most insidious in all of investing: the belief that a detailed model can substitute for clear thinking. It's the trap of false precision. Investors who fall into this trap build a beautiful spreadsheet that tells them a stock is worth $173.24. They become so anchored to that number, so in love with the elegance of their own model, that they fail to see the gaping flaw in their core assumptions. The model becomes a tool for justifying a price they already want to pay, rather than a tool for discovering the truth. It provides comfort, not clarity. The financial transformation we are about to embark on is a journey away from that comfort and toward that clarity. You will learn to silence the noise, to ignore the thousands of variables that flicker and dance and demand your attention but ultimately mean nothing. You will learn to identify the one or two fundamental pillars that hold up the entire financial edifice of a business. This is not about being lazy. It is about being intellectually efficient. It is about focusing your finite mental energy on what truly matters. It is about developing the CEO mindset, which is not concerned with the trivial details, but with the big, strategic decisions that will shape the company's destiny for decades to come. By the end of our journey, you will understand how to make faster, more confident, and profoundly more accurate investment decisions than the person paralyzed by a spreadsheet with 1,000 tabs. You will learn that in the world of stock picking, the person with the simplest, most robust understanding of the business reality is the one who ultimately wins. The napkin is not a limitation. It is a filter. It is a weapon of clarification. And it is the secret to building a portfolio capable of achieving true, lasting financial freedom. Our exploration of this powerful mental model will be built on 5 fundamental pillars. First, we will confront the great enemy, the tyranny of false precision, and understand why our brains are so dangerously drawn to complexity. Second, we will uncover the power of inescapable business realities, learning how Buffett identifies the core economic engine that drives a company's value. Third, we will explore the circle of competence as an intellectual filter, realizing that simplicity is not a shortcut, but a result of profound understanding. Fourth, we will embrace the margin of safety as the ultimate simplifier, the principle that makes precise valuation unnecessary. And finally, we will cultivate the temperament of decisive inaction, the psychological fortitude required to wait for the perfect opportunity and then act with overwhelming force. Each pillar builds on the last, constructing a complete framework not just for investing, but for thinking clearly about business and capital allocation in a world determined to confuse you. This is the Warren Buffett strategy, stripped down to its powerful, elegant core. We begin with the enemy, the great intellectual sin that Buffett has spent a lifetime avoiding. We must first understand the allure of the siren's song before we can learn to resist it. We must venture into the heart of the storm, into the world of complex models and flawed genius, to truly appreciate the simple genius of the man from Omaha. Let us explore the first pillar, the tyranny of false precision. It was the mid-1990s, an era of supreme confidence. The Cold War was over, the internet was blossoming, and on a quiet, secluded campus in Greenwich, Connecticut, a collection of the most brilliant minds on the planet believed they had finally, irrevocably, solved the puzzle of financial markets. This was the headquarters of Long-Term Capital Management, or LTCM, and it wasn't just another hedge fund, it was an intellectual Mount Olympus. On its board were Myron Scholes and Robert C. Merton, who would soon win the Nobel Prize in Economics for their work on options pricing, the famous Black-Scholes model. The trading floor was staffed with PhDs in physics and mathematics, legendary bond traders, and a former vice chairman of the Federal Reserve. They were, by any objective measure, the smartest guys in any room they entered. Their strategy was built on a foundation of staggeringly complex mathematical models. They looked for tiny, fleeting pricing discrepancies between related securities around the world, a fractional difference in the yield of 2 different government bonds, for instance. Their models, running on powerful computers, could identify these micro-anomalies and calculate the precise statistical probability of them converging back to normal. The profits on any single trade were minuscule, so to make real money, they had to use leverage, immense, earth-shattering leverage. For every $1 of their own capital, they borrowed more than $25. By 1998, the fund had over $100 billion in assets, propped up by a sliver of its own capital, and its trading positions had tentacles reaching into every corner of the global financial system, with a notional value exceeding $1 trillion. Their confidence was absolute because their models were so precise. They could show you, with mathematical certainty, that the risk of ruin was infinitesimally small. Their value-at-risk models predicted that the fund would lose, at most, $35 million on any given day. They had, they believed, created a perfect money machine, a scientific approach to investing that had rendered old-fashioned business analysis obsolete. Warren Buffett, at the time, was seen by many in this new world of quants as a relic, a folksy anachronism who bought candy companies and insurance agencies. He didn't use their formulas. He couldn't even program a computer. What could he possibly know about the new, digitized, globalized market? Then, In the summer of 1998, the unthinkable happened. Russia, a country whose bonds LTCM's models deemed safe, defaulted on its debt. It was a 10 sigma event, a statistical impossibility, something their models predicted would happen only once in the history of the universe. But it happened, and it triggered a global flight to safety. Investors everywhere dumped risky assets and fled to the safest U.S. Treasury bonds. The tiny pricing discrepancies that LTCM had bet on converging did the exact opposite. They blew out to unprecedented levels. Their models, their beautiful Nobel Prize-winning models, were not just wrong, they were catastrophically wrong. In the space of a few weeks, the fund lost $4.6 billion, vaporizing its entire capital base. The smartest guys in the room were wiped out. Their trillion-dollar web of trades threatened to unravel and take the entire global financial system down with it, forcing the Federal Reserve to orchestrate a massive, unprecedented bailout by the very Wall Street banks that would have been crushed in LTCM's collapse. Years later, when asked about the downfall of LTCM, Buffett delivered one of his most famous and devastating critiques. He said to make money they didn't have and didn't need, they risked what they did have and did need. That is foolish. It is just plain foolish. If you risk something that is important to you for something that is unimportant to you, it just does not make any sense. But his deeper critique was of their methodology. He saw that their intricate models had given them a profound but dangerous illusion of understanding. They had mistaken mathematical elegance for real-world truth. They had forgotten that markets are not physics experiments. They are driven by fear and greed, by human beings who, in a panic, do not behave like rational, predictable particles. Buffett famously quipped, "Beware of geeks bearing formulas." He wasn't being anti-intellectual. He was warning against the hubris that comes from believing a spreadsheet can capture the raw, unpredictable power of human nature. The team at LTCM had 1,000 answers, all precise to the 5th decimal place, but they had failed to ask the one simple napkin-sized question: what happens if we're wrong? The answer for them was ruin. For Buffett, whose entire approach is built on acknowledging the possibility of being wrong, the answer is survival and ultimately prosperity. The LTCM saga is the ultimate foundational anecdote for the tyranny of false precision, a multi-billion-dollar testament to the fact that it's better to be vaguely right than precisely wrong. The spectacular implosion of long-term capital management is not just a story about flawed financial models, it's a profound case study in human psychology. It reveals the dark side of our cognitive machinery, the deep-seated biases that make the illusion of precision so seductive and so dangerous. At the heart of this phenomenon lie two powerful psychological principles: the overconfidence bias and the illusion of control. The overconfidence bias is our universal tendency to overestimate our own knowledge and abilities. The PhDs at LTCM were not just smart, they knew they were smart. Their Nobel Prizes and academic accolades served as constant reinforcement. This created an intellectual echo chamber where their own brilliance was a given, and the possibility of a fundamental flaw in their thinking was almost inconceivable. When you believe you are the smartest person in the room, you are less likely to question your own assumptions. Their complex models were a manifestation of this overconfidence. The very intricacy of the formulas became proof of their validity. Who could argue with pages of dense calculus? It was intimidating, authoritative, and it projected an aura of unassailable genius. This overconfidence was supercharged by the illusion of control. This is the cognitive bias where people overestimate their ability to control events. A simple example is a gambler blowing on the dice before a roll, believing this action can somehow influence the outcome. For the managers at LTCM, their complex models were their way of blowing on the dice. By quantifying risk down to the last basis point, by modeling every conceivable variable, they felt they had tamed the wild randomness of the market. They believed they weren't just participating in the market, they were managing it, controlling it. The spreadsheet, with its thousands of inputs, becomes a cockpit. You can tweak this assumption, adjust that variable, and see the projected outcome change in real time. This creates a powerful, godlike feeling of command. You feel that because you can model it, you can control it. This is a profound and dangerous delusion. The map, no matter how detailed, is not the territory. The financial model, no matter how complex, is not the economy. Buffett understands this at a gut level. His simple investing approach is an exercise in intellectual humility. He accepts that the world is inherently uncertain and that he cannot control it. His focus is therefore not on creating a perfect model to predict the future, but on finding businesses so robust that they don't require a perfect future to thrive. Furthermore, these complex models become fertile ground for another powerful bias, confirmation bias. This is our tendency to search for, interpret, and favor information that confirms our pre-existing beliefs. Imagine an analyst who is already emotionally committed to buying a particular stock. They build a discounted cash flow model. If the initial output suggests the stock is overvalued, they don't abandon their belief. Instead, they go back into the model and start tweaking. Maybe the long-term growth rate is a little conservative, they'll muse. Let's bump it from 3% to 3.5%. They'll adjust the discount rate down by 1/4 of a point, arguing that the company is less risky than they first thought. They continue this process of subtle manipulation until the model produces the answer they wanted all along: buy. The complex spreadsheet has not served as a tool of objective discovery. It has become a sophisticated justification machine. It launders a gut feeling through a process that looks rigorous and scientific, giving the investor the intellectual cover they need to do what they wanted to do anyway. Buffett's back-of-the-napkin approach short-circuits this entire process. A simple calculation is harder to manipulate. You can't hide a flawed assumption in a footnote on tab 74 of a spreadsheet. The core logic is laid bare, exposed for what it is. It forces a brutal honesty that complex models are designed to obscure. To break free from this tyranny, you need a practical mental model, a blueprint you can apply to your own investment decisions. Let's call it the intellectual inquisition. This is a step-by-step process designed to dismantle the false comfort of complexity and force you to focus on what truly matters. First, take any stock you currently own or are considering buying, and locate the analysis that supports your decision, whether it's a spreadsheet you built, an analyst report you read, or even just a set of mental assumptions. Your first step is to identify the load-bearing walls of your argument. List every single assumption that underpins your investment thesis. Don't be lazy. Write them all down. Revenue growth in year 5, gross margins, the terminal growth rate, the discount rate, competitor market share, everything. You might end up with 20, 30, even 50 variables. Second, you must conduct a brutal stress test on each assumption. This is the inquisition. For each variable on your list, ask yourself 3 questions. 1. What if this number was 0? 2. What if this number was double what I've projected? 3. What if this number was negative? The purpose is not to find the right answer, but to understand the sensitivity of your conclusion. You will quickly find that many of your dozens of assumptions are surprisingly irrelevant. Changing them, even dramatically, doesn't meaningfully alter the final valuation. These are the trivial details, but you will also find a small number of assumptions, perhaps only 2 or 3, that are terrifyingly powerful. If these specific assumptions are wrong, your entire investment thesis collapses. For a tech company, it might be the long-term user growth rate and the average revenue per user. For a retailer, it might be same-store sales growth and gross margin. These are the variables that matter. Third, and this is the most critical step, you must discard everything else. Take your beautiful complex model and delete it. Throw away the analyst report. Erase the whiteboard. Now, start over with a blank sheet of paper, or the back of a napkin. On this new, clean slate, you are only allowed to build your thesis using those 2 or 3 critical variables you identified. This act of forced simplification is transformative. It clears away the fog. Your job as an investor is no longer to predict 50 different things with mediocre accuracy. Your job is to become a world-class expert on the 2 or 3 things that will actually drive the company's long-term value. This process translates the abstract danger of false precision into a concrete, actionable method for achieving clarity. It's the first step in adopting a true Warren Buffett strategy, moving from the cluttered world of the analyst to the focused world of the business owner. It's how you begin the journey toward making better, more robust investment decisions. To truly appreciate the wisdom of this simplified approach, we must spend a moment walking the path of the 99%, observing the antithesis of Buffett's method. Picture the modern retail investor, often intelligent, ambitious, and equipped with powerful tools. Let's call him Alex. Alex has a subscription to a sophisticated financial data service, he has built a custom discounted cash flow template in Excel, and he follows a dozen expert accounts on social media. He has decided to analyze a popular software-as-a-service company. For the next 3 days, Alex is a whirlwind of activity. He pulls 10 years of financial statements, meticulously inputting every line item. He builds out projections for the next decade, debating whether revenue growth in year 7 should be 17.5% or 18%. He models changes in marketing spend, research and development, and share-based compensation. He runs a Monte Carlo simulation, a statistical technique that runs thousands of variations to create a probability distribution of outcomes. His final spreadsheet is a masterpiece of complexity. It has color-coded tabs, dynamic charts, and a sensitivity analysis that shows how the valuation changes based on a dozen different inputs. At the end of this exhausting process, the model tells him the company's intrinsic value is $254.17 per share. The stock is currently trading at $248. Alex feels a surge of triumph. He has done the work. His model, a fortress of data, tells him to buy. But what has Alex really accomplished? He has fallen into the classic trap of paralysis by analysis. He spent 95% of his time on variables that account for maybe 10% of the long-term outcome. He was so focused on the intricate mechanics of his spreadsheet that he failed to step back and ask the big, simple questions. He never called a customer of the company to ask if they liked the product. He never spent time trying to understand the durability of the company's competitive advantage. He can't articulate in a single, clear sentence why this company will be earning more money a decade from now. His confidence is not in the business, it is in his model. And this is a fragile foundation. When the company releases its next quarterly report and misses revenue estimates by a mere 1%, panic sets in. The market price drops to $220. Alex's model, based on his precise inputs, did not predict this. His faith is shaken. The illusion of control shatters. Does he buy more because his model still says it's undervalued? Or does he sell because the reality has deviated from his forecast? He doesn't know, because he never developed a true conviction in the underlying business. He was a spreadsheet operator, not an investor. This is the path of the 99%, a flurry of intellectual activity that creates the feeling of progress, but ultimately leads to confusion, indecision, and poor returns. It's the opposite of the decisive, confident CEO mindset that Buffett embodies, a mindset that comes from focusing only on the inescapable truths of a business. The financial consequences of this obsession with false precision are not merely academic, they are devastating, and they manifest directly in your portfolio's performance. The first and most obvious impact is on your transaction costs and tax bill. The investor who relies on a complex model, like Alex, has a confidence that is brittle. When the chaotic reality of the market deviates from the clean lines of their forecast, they are quick to sell. Their belief was in the spreadsheet, not the business. This leads to excessive trading, or churn. Each trade, whether a buy or a sell, incurs costs, commissions, fees, and the bid-ask spread. More importantly, every time a winning position is sold, it triggers a taxable event, forcing you to pay capital gains taxes. This is a catastrophic leak in the boat of your wealth-building journey. Compounding, the engine of all great fortunes, works best in an uninterrupted, untaxed environment. Constant trading starves the compounding machine of its fuel. The simple, napkin-style investor, by contrast, develops a deep conviction in the business itself. They are not shaken by quarterly noise because their thesis isn't based on quarterly projections. This allows them to hold on for the long term, minimizing taxes and transaction costs and letting the magic of compounding work its wonders. This discipline is a core tenet of effective wealth management. Secondly, the tyranny of false precision leads to a phenomenon known as diversification. An investor who lacks true conviction in any single idea will tend to own a little bit of everything. They might have a portfolio of 50 or 100 stocks, each one supported by a complex model. But their actual understanding of any individual business is shallow. They are unknowingly creating their own personal index fund, but one that is far more expensive and less efficient than a real one. They are diversifying away not just risk, but also their chances of achieving spectacular returns. Buffett's approach leads to the opposite, a concentrated portfolio. Because his method requires such deep thought and a high bar for inclusion, he makes very few investment decisions. But when he does, he invests with significant size and conviction. This is how you achieve portfolio growth that is capable of beating the S&P 500. You don't do it by owning 100 mediocre ideas. You do it by owning a handful of truly great ideas that you understand intimately. This level of concentration would be terrifying for someone relying on a complex model, because they know, deep down, how fragile their assumptions are. But for an investor armed with a simple, robust understanding of a business's core reality, concentration is not risk. It is the logical expression of confidence. Ultimately, the financial connection is clear. Complexity breeds fragile confidence, which leads to overtrading and diversification, destroying capital through taxes and fees. Simplicity, on the other hand, breeds robust conviction, which leads to long-term holding and focused concentration, the twin engines of massive capital gains. Having fully explored the dangers of our enemy, the tyranny of false precision, we can now turn toward the solution. We must learn to replace the complex and misleading with the simple and powerful. This brings us to our second pillar, the very heart of the one napkin method, the power of inescapable business realities. This is the art of looking at a sprawling, complex enterprise and identifying the single beating heart that pumps cash through its veins. It is about discovering the core economic engine that, above all else, determines its long-term fate. In 1972, Warren Buffett and Charlie Munger were presented with an opportunity to buy a company called See's Candies. On the surface, it looked expensive. The asking price from the See family was $30 million, while the company had only $8 million in tangible assets like buildings and inventory. The remaining $22 million was for something called goodwill, an intangible asset that most investors at the time viewed with deep suspicion. For an investor schooled in the rigid, asset-based value investing of Benjamin Graham, this was a clear signal to walk away. You were supposed to buy businesses for less than the value of their physical assets, not for nearly 4 times that amount. A standard financial model of the day would have screamed, quote, overvalued. It would have focused on the book value, the inventory turnover, the fixed asset depreciation schedule, a litany of details that missed the entire point. But Buffett and Munger didn't start with a spreadsheet. They started by thinking about the business. They saw a company that had a fanatical customer base, particularly in California. For decades, people had been giving boxes of See's Candies as gifts for Christmas, Valentine's Day, and birthdays. The brand was deeply embedded in the emotional fabric of family traditions. A customer walking into a See's store wasn't just buying chocolate. They were buying a feeling of nostalgia, quality, and affection. This emotional connection created a powerful, inescapable business reality. Pricing power. Buffett realized that a customer who was going to his new girlfriend's house for the first time was not going to risk showing up with a cheap, generic box of chocolates to save $1. He was going to buy the trusted, high-quality brand. This gave See's the ability to raise its prices by a small amount every single year, year after year, without any meaningful loss of customers. The cost of the ingredients, sugar, cocoa, might go up, but See's could pass those costs, and then some, right along to the consumer. This single insight, the durable pricing power born from brand loyalty, was the entire investment thesis. It was the one variable that mattered above all others. They could do the calculation on the back of a napkin. The company was earning about $2 million a year after tax. A $30 million purchase price meant they were paying a multiple of 15 times earnings. But because of the pricing power, those earnings weren't static. They were destined to grow consistently and predictably for decades to come. That small annual price increase would cascade directly to the bottom line, requiring almost no additional capital investment. It was a royalty on the affection of its customers. They bought the company. Over the years, See's Candies has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, all while requiring very little new capital. It became what Buffett calls a, quote, gusher, a business that produces far more cash than it consumes. The initial $30 million investment, which seemed so expensive to the spreadsheet jockeys of the world, turned out to be one of the greatest investments of all time. The story of See's Candies is the foundational anecdote for our second pillar. It teaches us that the most important variable in a stock analysis is often not found on the balance sheet. It is found in the minds and hearts of a company's customers. It is an inescapable business reality that no complex model could ever hope to capture. The human mind is a peculiar machine for processing information. It has evolved over millennia to react quickly to immediate threats and opportunities. This evolutionary wiring manifests in the modern world as a powerful cognitive flaw known as salience bias. We are naturally drawn to things that are vivid, recent, and emotionally charged. In the context of investing, the salient information is the daily stock price, the breaking news headlines, the dramatic pronouncements of TV pundits, and the latest quarterly earnings report. These things are flashy, they are constantly changing, and they hijack our attention. They feel important. Meanwhile, the truly important factors that drive a business's long-term value are often slow-moving, boring, and almost invisible. The gradual strengthening of a brand, the slow increase in customer switching costs, the patient expansion of a distribution network, these are the tectonic plates of business value, shifting slowly but with immense, unstoppable force. Salience bias causes us to ignore these tectonic plates and instead obsess over the noisy weather patterns on the surface. Warren Buffett's genius is, in large part, a triumph over salience bias. His entire method is a deliberate filter designed to ignore the vivid but irrelevant noise and focus solely on the boring but powerful underlying realities. When he analyzed See's Candies, the salient information was the high purchase price relative to book value. It was a glaring bright red number that would have scared off 99% of investors, but Buffett forced himself to look past it. He was searching for the non-salient truth. He found it in the quiet, unchanging loyalty of a See's customer, a loyalty built up over decades of positive emotional experiences. This is a factor that never appears in a headline. It doesn't show up in a quarterly report. You can't plot it on a chart. But it was the single most powerful economic reality of the business. This psychological principle explains why so many investors are drawn to story stocks, companies with exciting narratives and charismatic CEOs, even if their underlying business economics are terrible. The story is salient. The charismatic CEO giving a great interview is salient. The boring reality of negative cash flow and a commoditized product is not. It also explains why investors tend to sell good companies during market panics. The plunging stock price is the most salient piece of information imaginable. It is a blinking red light on your screen, screaming, "Danger!" It takes incredible psychological discipline to ignore that screaming alarm and focus on the non-salient question. Has the long-term earning power of this business been permanently impaired? More often than not, the answer is no, but salience bias makes it almost impossible for most people to see that. The one napkin method is a cognitive tool for overriding this bias. It forces you to define, in advance, what truly matters. It acts as an anchor of reason in a sea of salient noise. allowing you to maintain your focus on the long-term business reality while others are tossed about by the short-term waves of market emotion. To harness this power in your own investment process, you need a practical blueprint. Let's call it the one napkin question model. This is a mental exercise that forces you to distill a complex business down to its essential driver. It's a direct application of the simple investing philosophy that underpins the entire Warren Buffett strategy. The first step is to engage in a thought experiment. Imagine you are not just buying a few shares of a stock. You are buying the entire company outright. And there's a catch. You are not allowed to sell it for at least 10 years. This simple framing immediately changes your perspective. You are no longer a trader looking for a short-term price movement. You are an owner, and your fate is tied to the long-term health of the underlying business. The daily stock price becomes irrelevant. What matters is the cash the business will generate for you, its owner, over the next decade. The second step is to take out a physical napkin or a blank piece of paper. At the top, write this question: what is the single most important variable that will determine the amount of cash this business generates for its owners over the next 10 years? Now, you must answer it. This is not an easy task. It requires deep thought and a genuine understanding of the business model. Is it pricing power, like with See's Candies? Is it the low-cost operational model, like with Costco or Geico? Is it the network effect, like with Visa or American Express, where every new user makes the service more valuable for all other users? Is it a unique intellectual property, like a key patent for a pharmaceutical company? You must be relentlessly honest and intellectually rigorous. You have to find the primary bottleneck or the primary accelerator of long-term cash generation. The third and final step is to make a commitment. Your entire stock analysis from this point forward will be dedicated to understanding and projecting that one single variable. All other data, all other metrics are now demoted to a secondary, supporting role. If you've determined that a software company's key variable is its ability to prevent customer churn, then your research should be laser-focused on that. Talk to customers. Study competitor products. Analyze the switching costs. Your goal is to develop a level of expertise on that one crucial factor that is superior to almost anyone else in the market. This model prevents you from getting lost in the weeds. It provides a powerful, clarifying lens through which all new information is filtered. It transforms stock analysis from a passive exercise of data collection into an active investigation of the one business reality that truly matters. This is how you move from being a retail investor to thinking like a CEO. The antithesis to this focused, owner-like approach is the path followed by the vast majority of market participants, the momentum trader. Let's call her Sarah. Sarah is intelligent and tech-savvy, and she believes that in the modern market, the old rules of value investing are obsolete. Her strategy is to identify hot trends and ride the wave of positive sentiment. Her screen is filled with charts, technical indicators, and real-time news feeds. She isn't interested in a company's 10-year cash flow. She's interested in its 50-day moving average. She sees a stock in the electric vehicle sector that has been soaring. The news is filled with exciting announcements about new battery technology and government subsidies. The company's charismatic CEO is constantly on social media, generating hype. The stock price is a beautiful upward-sloping line. For Sarah, this is a clear buy signal. She buys a significant position, not because she has a deep understanding of the complex automotive manufacturing process or the long-term economics of battery production, but because the story is compelling and the price is going up. Sarah could not answer the one napkin question if her life depended on it. She has no idea what the key driver of long-term value is. Is it the cost per kilowatt hour of their batteries? Is it their manufacturing scale? Is it their brand loyalty? She doesn't know and she doesn't care. Her investment thesis is simply, it's going up. For a while this works. The hype continues, more traders pile in, and the stock price continues to levitate. Sarah feels like a genius. But then, the narrative shifts. A major competitor announces a breakthrough. A government subsidy program is reduced. The CEO makes a controversial statement. the tide of sentiment turns, and the stock price begins to plummet. Now, Sarah is in a terrifying position. She has no anchor of intrinsic value to hold onto. She has no idea if the stock is now cheap or if it's still wildly expensive. Her only reason for buying, the upward momentum, is gone. Fear takes over and she sells, locking in a massive loss. The momentum trader is the ultimate victim of salience bias. They are completely beholden to the noisy, ever-changing surface of the market. They build their financial house on the sand of public opinion, and when the winds change, it collapses. This is the path that ensures you will never achieve financial freedom, because it is based on speculation, not on the ownership of durable, cash-generating businesses. The direct financial connection between focusing on inescapable business realities and your investment returns is profound and can be summed up in 2 words: owner earnings. This is a concept Buffett popularized, and it is the ultimate metric for a napkin-style analysis. While most of the market is obsessed with reported net income, the number you see at the bottom of an income statement, Buffett knows this figure can be misleading. Accounting rules can distort the true economic reality of a business. A company might report high net income but have to spend all of that income, and more, just to maintain its competitive position, leaving no actual cash for the owners. Owner earnings provides a much more honest picture. The formula is simple enough for a napkin. Start with reported net income. Add back non-cash charges like depreciation and amortization, and then subtract the average annual amount of capital expenditures the business needs to maintain its long-term competitive position. This final part is the key. It requires judgment, not just accounting. You have to think like a business owner and ask, how much money do I have to reinvest back into this business each year just to keep it from falling behind? The cash that's left over is the true profit. That's the money that can be used to pay dividends, buy back shares, or be reinvested for growth. A company like See's Candies, with its powerful brand, required very little in capital expenditures to maintain its position. Almost all of its earnings were true owner earnings. A capital-intensive business like a steel mill or an airline might have to spend billions each year on new plants and equipment just to stay in the game, resulting in very low or even negative owner earnings, even if they report a positive net income. By focusing your analysis on this single, powerful metric, you connect your thinking directly to the cash flow that will ultimately drive your capital gains. You stop being a speculator on stock prices and become a partner in a business, focused on your share of the actual cash profits. This simple, powerful concept is the bridge between a qualitative understanding of a business's reality and the quantitative impact on your portfolio growth. It is the financial heart of the one napkin method. The ability to identify a company's core economic reality is a powerful skill, but it is useless and even dangerous if misapplied. You cannot hope to find the simple, driving truth of a business you do not fundamentally understand. This leads us directly to our third pillar, a concept that acts as a crucial safety rail on the entire Warren Buffett strategy, the circle of competence as an intellectual filter. This principle is not about limiting your ambition. It is about defining the boundaries of your knowledge with brutal honesty, ensuring that when you use your napkin, you are using it on a problem you are actually qualified to solve. The late 1990s were a difficult time to be Warren Buffett. The world had gone mad for technology. A new paradigm had been declared. Companies with no profits, no revenues, and in some cases, no finished products, were coming to the stock market and achieving valuations in the billions of dollars. Names like Pets.com, Webvan, and TheGlobe.com were the talk of Wall Street. It was the dot-com bubble, and the pressure to participate was immense. Barron's, a leading financial publication, ran a now infamous cover story in 1999 titled, "What's Wrong, Warren?" The article detailed Buffett's lousy performance, pointing out how Berkshire Hathaway's stock was lagging far behind the soaring Nasdaq index. He was openly mocked as a dinosaur, a man whose old-fashioned ideas about profits and value were irrelevant in the new digital age. His own shareholders were growing restless. He was losing them money, relatively speaking, by stubbornly refusing to invest in the technology stocks that were making their neighbors rich. During this period of intense criticism, Buffett remained completely unfazed. His reasoning was disarmingly simple, and he repeated it over and over again to anyone who would listen. He said, "I don't invest in businesses I don't understand." It wasn't that he thought all tech companies were bad investments. He was simply admitting that he didn't know how to tell the good ones from the bad ones. How could he, on the back of a napkin, confidently project the cash flows of a company like GeoCities 10 years into the future? He couldn't. The industry was changing too rapidly, the competitive landscape was a blur, and the business models were unproven. He knew how to analyze the durable competitive advantage of Coca-Cola or the underwriting discipline of an insurance company. He did not know how to analyze the network effects of an online search portal, and so he did nothing. He patiently sat on the sidelines, holding cash, while the world celebrated the new titans of tech. Then, in March of 2000, the bubble burst. The Nasdaq index, which had peaked above 5,000, began a brutal, soul-crushing decline. Over the next 2 years, it would fall by nearly 80%. The high-flying dot-com darlings were wiped out. Pets.com, which had spent millions on a Super Bowl ad, went bankrupt. Webvan, which had raised billions to build a grocery delivery service, collapsed. Trillions of dollars of speculative wealth vanished into thin air. And Warren Buffett, the dinosaur, was revealed to be the wisest man in the room. His discipline, his refusal to step outside his circle of competence, had protected his shareholders' capital from the carnage. This story is the foundational anecdote for the power of staying within your intellectual boundaries. It demonstrates that the most important part of investing is not finding the next big thing, but avoiding the big mistake. And the surest way to make a big mistake is to make a bet on a game you don't understand. The circle of competence is your defense against your own ignorance. The psychological principle underpinning the circle of competence is a direct antidote to one of the most pervasive cognitive biases, the Dunning-Kruger effect. This is the well-researched phenomenon where individuals with low ability or knowledge in a particular domain tend to dramatically overestimate their own competence. In simple terms, they are too ignorant to recognize their own ignorance. This effect is rampant in the world of investing. A person reads one article about artificial intelligence and suddenly believes they are qualified to pick the winning AI stocks for the next decade. Another watches a documentary on biotechnology and feels confident enough to invest their life savings in a small-cap company with a single drug in clinical trials. They are standing on the peak of what the Dunning-Kruger model calls Mount Stupid, a place of high confidence born from a little bit of knowledge. As one gains more expertise in a subject, their confidence often paradoxically drops, as they begin to appreciate the vastness of what they don't know. True experts like Buffett operate from a place of profound intellectual humility. They have a keenly calibrated sense of their own limitations. Buffett's discipline is also a powerful defense against the siren call of FOMO, the fear of missing out. During the dot-com bubble, the psychological pressure to join the party was immense. Every day, the news was filled with stories of ordinary people becoming millionaires overnight by betting on tech stocks. This creates a powerful social contagion. It triggers a deep-seated fear that if you don't act now, you will be left behind, a financial failure. FOMO is an emotional response, not a rational one. It short-circuits our analytical thinking and pushes us toward impulsive action. The circle of competence acts as a rational circuit breaker. When you feel the pull of FOMO for a hot stock in an industry you know nothing about, your predefined circle acts as a hard stop. You can tell yourself, this may be a great opportunity, but it is not an opportunity for me. It lies outside the boundaries of my knowledge, and therefore I am not qualified to play. This transforms the decision from an emotional struggle into a simple, rule-based process. By defining what you don't know, you neutralize the power of FOMO and protect yourself from being swept up in the speculative manias that periodically grip the market. This is a crucial element of building a robust, long-term wealth management strategy. To make this concept a practical tool, you can use a mental model I call the Teach a 10-year-old test. This is a simple yet surprisingly effective method for determining whether a potential investment truly lies within your circle of competence. It's a core exercise in simple investing that cuts through jargon and complexity. The first step is to pick a company you are considering investing in. Before you look at a single financial number, you must be able to pass this test. Find a quiet room and, speaking out loud as if you were explaining it to a child, describe exactly how this company makes money. Be specific. Don't use buzzwords like monetizing a platform or leveraging synergies. If it's a software company, explain what the software does, who pays for it, and why they are willing to pay for it. If it's a railroad, explain that they own long tracks of steel, and other companies pay them to move heavy things like grain and cars from one place to another. If you find yourself resorting to vague jargon, that is a red flag. You do not understand the business at its most fundamental level. The second, and more difficult, part of the test is to explain, in the same simple terms, why this company will be making more money in 10 years than it is today. This forces you to articulate the company's competitive advantage, its moat. Will it be because they can sell more of their product? If so, why? Will it be because they can charge higher prices? If so, what gives them that power? Will it be because their costs will go down? How? Again, if you cannot explain this in a way that a reasonably intelligent 10-year-old could grasp, then you are likely venturing outside your circle of competence. This test is powerful because it forces you to substitute genuine understanding for the illusion of knowledge that comes from reading analyst reports or industry publications. It's easy to parrot sophisticated-sounding arguments. It is incredibly difficult to distill a complex business down to a simple, durable truth. If a business is so complex that it cannot pass this test, it is probably not a suitable investment for a long-term, value-oriented investor. This blueprint protects the retail investor from their own overconfidence and ensures that their stock picking is confined to areas where they have a genuine analytical edge. The antithesis of this disciplined approach is the average investor's experience, particularly during periods of market euphoria. Consider the speculative mania of 2021. The market was flooded with new participants, drawn in by stories of instant riches in cryptocurrencies, meme stocks, and non-fungible tokens, NFTs. Let's call this investor Tom. Tom was a smart person, a professional in his own field, but he knew very little about finance. He saw his friends and colleagues posting on social media about their massive gains in a cryptocurrency with a dog on it, or a struggling video game retailer stock that was going to the moon. Driven by a powerful combination of FOMO and the Dunning-Kruger effect, Tom decided he needed to get in on the action. He opened a trading account on his phone and, without any real research, bought a portfolio of the hottest assets of the day. If you had asked Tom to explain the business model of the video game retailer, he might have mumbled something about a short squeeze and diamond hands, terms he had learned from an online forum. He couldn't have told you anything about their declining retail sales, their strategy for digital transformation, or their cash flow situation. If you had asked him to explain the utility or intrinsic value of the cryptocurrency he bought, he couldn't have. His investment thesis was based entirely on social proof and the hope that he could sell it to someone else at a higher price later. He was operating miles outside of any circle of competence. He was not investing, he was gambling, wrapped in the language of a new technological movement. When the tide inevitably went out in 2022 and these speculative assets crashed by 80 or 90%, Tom was completely wiped out. He had no conviction to hold on, because his initial purchase was not based on any understanding of underlying value. He was a tourist in a dangerous world, and he paid the price. This is the path of the 99%, chasing narratives they don't understand, mistaking complexity and novelty for a genuine investment opportunity, and ultimately serving as the liquidity for more disciplined market participants. The direct financial connection between rigorously defining your circle of competence and your portfolio's results is all about risk management and the mathematics of long-term returns. The most important number in investing is not the one with the highest potential upside, but the number one. As in, never lose your principal. Buffett's first rule of investing is never lose money, and his second rule is never forget rule number one. Avoiding catastrophic loss is mathematically more important than achieving spectacular gains. If you have a portfolio of $100,000 and you lose 50%, you are down to $50,000. To get back to your starting point, you now need to achieve a 100% return, a much more difficult feat. A single massive loss can set your journey to financial freedom back by years or even decades. Staying within your circle of competence is the most effective way to avoid these catastrophic losses. When you invest in a business you truly understand, you are far less likely to be surprised by negative developments. You can anticipate the competitive threats, you understand the cyclical nature of the industry, and you have a realistic view of the long-term prospects. This dramatically reduces the probability of an investment that goes bankrupt and wipes out your entire investment. Your portfolio might not always have the single hottest stock of the year, but it will be far less likely to contain the spectacular blow-ups that cripple the portfolios of less disciplined investors. This focus on avoiding losers, rather than just picking winners, is the secret to superior long-term performance. Over decades, a portfolio that consistently generates good, solid returns and avoids major drawdowns will almost always outperform a portfolio that experiences wild swings, even if it occasionally catches a huge winner. This is how you structure your asset allocation for resilience. By filtering your investment decisions through your circle of competence, you are building a financial fortress, protecting your capital from your own biggest enemy, your own ignorance. This is the foundation upon which all lasting wealth is built. Now we arrive at a pillar that injects a profound sense of calm and rationality into the entire investment process. Once you have filtered out complexity and confined yourself to businesses you understand, you still face the critical task of valuation. But what if you didn't need to be precise? What if you could build a system where being approximately right was more than good enough? This brings us to our fourth pillar, the margin of safety, the ultimate simplifier. This is the principle that bridges the gap between an uncertain future and a profitable present. It is the bedrock of all true value investing. In the fall of 1963, the financial world was rocked by a bizarre and devastating scandal. A small, unassuming company in New Jersey called the Allied Crude Vegetable Oil Refining Company, run by a man named Tino De Angelis, had perpetrated one of the greatest frauds in modern history. The company borrowed massive sums of money from banks and financial institutions, with the loans secured by its vast inventory of salad oil, stored in giant tanks in Bayonne, New Jersey. The primary lender, and the one providing the warehouse receipts that guaranteed the oil's existence, was a subsidiary of one of the most trusted names in American finance, American Express. The problem was, the oil didn't exist. De Angelis had filled the tanks mostly with water, with a few feet of oil floating on top. When the fraud was discovered, Allied Crude collapsed, defaulting on loans worth what would be over $1 billion in today's money. Panic erupted. American Express, the guarantor, was on the hook for the massive losses. Wall Street feared the company would be bankrupted. The stock, a blue-chip stalwart, collapsed, falling nearly 50% in a matter of months. This was a moment of peak fear and uncertainty. The headlines were terrifying. The story was complex. No one knew the true extent of American Express's liability. Most investors, even professionals, fled the stock in terror. But in Omaha, a young Warren Buffett saw not chaos, but opportunity. He did not build a complex model to project the exact legal liabilities. He didn't try to predict the outcome of the impending lawsuits. He used a simple, napkin-style approach. He recognized that the scandal, while serious, was confined to one small division of the company. The real value of American Express was in its core businesses, the iconic charge card and the traveler's checks. So he did his own real-world research. He went to restaurants and stores around Omaha. He talked to cashiers and merchants. He observed customers. He saw that people were not stopping their use of the card. He talked to bankers and travel agents, and saw that the traveler's check business was completely unaffected. The brand, the trust that had been built over decades, was still intact with the end consumer. He did a simple calculation. He determined that the core businesses were earning a certain amount of money per share, and that this earning power was not only safe, but likely to grow. He then compared that earning power to the collapsed stock price. He realized that the market, in its panic over the salad oil scandal, was pricing the entire company as if the core, highly profitable businesses were worth almost nothing. He was being offered the chance to buy a superb business at a price that provided a colossal margin of safety. Even if the salad oil losses were worse than anyone imagined, even if his own earnings estimates were overly optimistic, the price was so low that he was still highly likely to make a significant profit. He invested 40% of his partnership's capital into American Express stock. Within a few years, the market realized its mistake. The scandal faded, and the stock price soared, making a fortune for Buffett and his partners. The salad oil scandal is the ultimate foundational anecdote for the margin of safety. It teaches that the best opportunities are found not in serene certainty, but in moments of maximum pessimism, when the market offers you a wonderful business for a price so low that it provides a massive cushion against the uncertainties of the world. The psychological power of the margin of safety is immense, primarily because it serves as a powerful antidote to one of the most fundamental and painful human emotions, loss aversion. Decades of research in behavioral economics, pioneered by psychologists Daniel Kahneman and Amos Tversky, have shown that for most people, the pain of a loss is roughly twice as potent as the pleasure of an equivalent gain. Losing $100 feels as bad as winning $200 feels good. This asymmetry is wired into our brains. It makes us inherently risk-averse and prone to panic when our investments start to decline in value. When you buy a stock at what you believe is its fair value, and then it drops by 20% due to market volatility, loss aversion kicks in with brutal force. The pain is intense. It creates a powerful urge to sell, to make the pain stop, even if the long-term prospects of the business have not changed. This is why so many investors end up buying high, in a state of euphoria, and selling low, in a state of panic. The margin of safety is a psychological shield against this destructive impulse. When you buy a business for 50 cents that you believe is conservatively worth $1, your entire mental framework changes. When the stock price then drops from 50 cents to 40 cents, your reaction is not panic, it is often excitement. You are not thinking, "I'm losing money." You are thinking, "The market is now offering me this dollar for an even bigger discount." The large gap between your purchase price and your conservative estimate of intrinsic value creates a buffer of confidence. It allows you to withstand the inevitable storms of market volatility with equanimity or even greed. You are anchored to your own independent assessment of value, not to the fluctuating whims of the market price. This prevents you from being shaken out of a good position at the worst possible time. It is a tool for emotional regulation, allowing you to act rationally when others are driven by fear. By insisting on a margin of safety, you are not just making a financial decision, you are preemptively managing your own future emotional state, ensuring you have the fortitude to see your investment thesis through to its profitable conclusion. To operationalize this principle, we can use a straightforward blueprint called the 50-cent dollar model. This is the practical application of the margin of safety, turning a philosophical concept into a hard and fast rule for your investment decisions. The first step is to arrive at a valuation for a business, using your simple, one-napkin analysis focused on its key economic driver. This is your estimate of its intrinsic value. A crucial part of this step is to be deliberately conservative. When you are estimating future growth rates or profit margins, always choose the less optimistic, more reasonable number. Your goal is not to find the most exciting possible outcome, but the most probable and conservative one. Let's say, after this rigorous and conservative process, you determine that a company's intrinsic value is approximately $100 per share. This is your dollar. The second step is to apply your margin of safety. You must decide on a fixed discount that you require before you are willing to make a purchase. For the classic value investor, this is often 50%. This means your buy price, the price at which you are willing to act, is not $95 or $80. It is $50. This is your 50-cent dollar. This number should be written down. It is your line in the sand. The third and psychologically most difficult step is to do nothing until the market offers you your price. The stock might trade at $70 for months. The news might be good. Analysts might be upgrading it. You will feel tempted to cheat, to revise your buy price up to $60, telling yourself it's close enough. You must resist this temptation. The 50-cent dollar model is a rule of discipline. You wait patiently for the market to serve up your opportunity. This might mean waiting for a general market correction, or for some bad news specific to the company that causes a temporary overreaction from other investors. The key is that the decision to buy becomes almost automatic. When the price hits your predetermined number, you act. Emotion is removed from the equation. This simple, rule-based model is the essence of a successful stock-picking strategy. It forces patience, it enforces discipline, and it ensures that every investment you make has a powerful, built-in cushion that protects you from a world of uncertainty and from your own fallibility. The antithesis of this disciplined, price-sensitive approach is the growth at any price, or GAAP investor. This style of investing became particularly popular during the bull markets of recent decades. Let's call this investor David. David is a brilliant business analyst. He is fantastic at identifying wonderful, innovative companies with huge growth potential and strong competitive advantages. He finds a revolutionary software company that is growing its revenues at 50% per year and has a visionary CEO. David does deep research and correctly concludes that this is a truly exceptional business that will likely dominate its industry for years to come. He has successfully identified a high-quality enterprise. But then, he makes a fatal mistake. He falls in love with the company and decides he has to own it, regardless of the price. The stock is trading at a valuation of 50 times its annual sales, a historically astronomical figure. David justifies this price to himself. He builds a complex spreadsheet, just like Alex from our first pillar, projecting massive growth far into the future to make the numbers work. He tells himself, for a company this good, valuation doesn't matter. He buys the stock at its peak, paying a price that leaves absolutely no room for error. There is no margin of safety. This makes his investment incredibly fragile. A few months later, the company reports earnings that are merely, quote, great, not spectacularly amazing. Revenue growth slows from 50% to a still fantastic 40%. For a normal company, this would be incredible news. But for a stock priced for perfection, it is a disaster. The market sentiment shifts, and the stock price plummets by 60%. David is now in a terrible position. The business is still excellent, but he has suffered a massive capital loss because the price he paid was untethered from a conservative assessment of its value. The GAAP investor confuses a great business with a great investment. The truth is that even the best business in the world can be a terrible investment if you overpay for it. The margin of safety is the critical link that ensures you are not just buying quality, but you are buying it at a price that leads to exceptional portfolio growth and significant capital gains. The direct financial connection between the margin of safety and your bottom line is the most fundamental in all of investing. It is the codified source of profit. Your return on any investment is determined by two things: the fundamental performance of the business and the price you pay for it. The margin of safety is your primary tool for managing the second part of that equation. By insisting on buying at a significant discount to intrinsic value, you are essentially preloading your future returns at the moment of purchase. For instance, if you buy a stock for $50 that has an intrinsic value of $100, and the market price eventually converges with that value, you have locked in a 100% return. This return is generated purely from the closing of the price-value gap, separate from any additional gains that might come from the business's own growth. This creates multiple ways to win. First, you profit if your valuation is correct, and the market recognizes it. Second, the business itself can grow, increasing its intrinsic value over time and providing an even greater return. But most importantly, the margin of safety provides downside protection. If you were wrong in your initial assessment, and the business is only worth $70 instead of the $100 you calculated, your $50 purchase price still allows you to come out with a profit. The margin of safety is your room for error. On a balance sheet, this is the equivalent of having a huge amount of shareholder equity relative to your debt. It's a buffer that can absorb shocks. In your portfolio, it creates robustness. A portfolio built on this principle will have lower volatility and will recover more quickly from market downturns. It transforms investing from a speculative act of forecasting a precise future into a business-like act of exploiting a present-day discrepancy between price and value. This is the surest path to generating consistent, long-term capital gains and is the cornerstone of any serious wealth management strategy. We have now assembled a powerful set of intellectual tools. We know to reject the tyranny of false precision, to focus on inescapable business realities, to stay within our circle of competence, and to demand a margin of safety. But possessing these tools is not enough. The final, and perhaps most difficult challenge is a psychological one. It is the ability to use these tools with the right temperament, to act with courage when it is called for, and, more often, to do nothing at all. This brings us to our fifth and final pillar, the temperament of decisive inaction. This is the bridge between knowing what to do and actually being able to do it, year after year, in the face of immense pressure to do otherwise. On October 19, 1987, the global financial markets experienced their single worst day in modern history. The Dow Jones Industrial Average plunged by 508 points, a staggering 22.6% loss. It was Black Monday, a day of pure, unadulterated panic. Fortunes were wiped out in hours. The mood on Wall Street was apocalyptic. Investors, from the smallest retail participant to the largest institutions, were dumping stocks indiscriminately, desperate to sell at any price to escape the carnage. In the midst of this chaos, Warren Buffett remained a picture of calm in Omaha. He had been watching one particular company for years, almost half a century in fact. He had first bought its stock as a young man and had followed its story ever since. The company was Coca-Cola. He understood its business model with a clarity and depth that few people on the planet could match. He knew its product was simple, universally desired, and sold in virtually every country on Earth. He understood its incredible distribution system and the powerful psychological association the brand had with happiness and refreshment. He had done his napkin calculation many times. He knew, with a high degree of confidence, what the business was worth. For years leading up to 1987, the stock market had been in a roaring bull phase, and Coca-Cola's stock price was, in his view, too high. It offered no margin of safety. So despite his admiration for the business, he did nothing. He patiently waited. For years he sat on cash, a period of decisive inaction, while others chased the bull market higher. Then came the crash. In the panic of late 1987 and the nervous months that followed, the market offered him his price. The indiscriminate selling had dragged down the great companies, along with the mediocre ones. Coca-Cola's stock was now available at a valuation that was, by his conservative calculation, a significant discount to its intrinsic value. The business itself had not changed one bit. People were still drinking Coke on October 20th, just as they had on October 18th. Its long-term earning power was completely unaffected by the panic on Wall Street. Seeing the fat pitch he had been waiting for, Buffett acted with immense, decisive force. Over the next several months, Berkshire Hathaway invested over $1 billion, acquiring a huge stake in Coca-Cola. It was one of the largest single investments he had ever made. The story of his Coca-Cola investment is the quintessential anecdote for our final pillar. It was a masterpiece of temperament. Years of patient, disciplined inaction, followed by a sudden burst of massive, courageous action when the odds were overwhelmingly in his favor. The psychological hurdle that Buffett's temperament overcomes is the deeply ingrained action bias. Humans have a powerful instinctual drive to do something in response to a problem or a situation of uncertainty. Sitting still and doing nothing often feels counterintuitive and deeply uncomfortable. It can feel like laziness or passivity. In the context of investing, this bias is constantly stoked by the financial industry. The constant stream of news, the second-by-second flickering of stock quotes, the endless commentary from analysts, it all creates a sense of urgency, a feeling that you must be constantly reacting, adjusting, and trading to stay ahead. The entire ecosystem is designed to make you feel that activity equals progress. Doing nothing, in this environment, is an act of rebellion. It requires immense self-control. Buffett's ability to sit on his hands for years, waiting for the perfect opportunity, is perhaps his greatest and rarest skill. He understands that in investing, you do not get paid for activity, you get paid for being right, and to be right, you often need to wait for the market to make a mistake. This patience is paired with the opposite quality, extreme courage when the time is right. Most investors are like swimmers in a tide. They feel comfortable buying when everyone else is buying during a bull market, and are terrified to buy when everyone else is selling during a crash. Their actions are governed by social proof. Buffett's temperament is antithetical to this. His famous advice to be fearful when others are greedy and greedy when others are fearful is a direct instruction to fight against the pull of the social tide. This requires a contrarian mindset and a deep-seated confidence in your own analysis. When you are buying during a panic, like he did with Coca-Cola in 1987 or American Express in 1964, every headline is telling you that you are a fool. Every fiber of your being, conditioned by the social panic around you, is screaming at you to stop. To act decisively in that moment requires a temperament that is exceptionally rare. It is the combination of extreme patience and extreme courage that defines the ideal investing temperament. It is about understanding that the market is there to serve you, not to instruct you, and having the fortitude to wait for it to serve up a bargain on a silver platter. This is the ultimate CEO mindset. Long periods of strategic waiting, punctuated by moments of bold, decisive execution. To cultivate this temperament, you need a powerful mental model that forces you to raise the bar for every investment decision you make. Buffett himself provides the perfect one, the 20-slot punch card model. Imagine that at the beginning of your investing life, you are handed a punch card with only 20 slots in it. These 20 punches represent the total number of investments you are allowed to make in your entire lifetime. Once you've made 20, you're done. You cannot make any more. Suddenly, the entire game changes. You are no longer looking for a pretty good idea. You are no longer tempted to take a small flyer on a speculative stock. Every single decision carries an immense weight. Every investment must be of the absolute highest quality and conviction because it uses up one of your precious, irreplaceable slots. Before you buy any stock, you must pull out your metaphorical punch card and ask yourself, is this opportunity so good? Is my understanding of this business so deep? And is the price so attractive that I am willing to use 1/20th of my entire lifetime's allotment of investment decisions on it? This simple question is a profound filter. It immediately eliminates 99% of the ideas that come across your desk. It forces you to say no over and over and over again. It raises the standard for a yes to an extraordinarily high level. This mental model is the blueprint for decisive inaction. It makes patience the default setting. You are not just waiting for a good idea. You are waiting for an idea so compelling that it is worthy of a lifetime punch. And when such an idea does appear, a truly great business offered at a price with a massive margin of safety, the model also gives you the courage to act decisively. You know how rare these opportunities are, so when one arrives, you don't just dip your toe in, you back up the truck. You make a significant investment because you know it meets the highest possible standard. The 20-slot punch card model is a transformative tool for any retail investor, shifting their mindset from that of a short-term trader to that of a long-term, high-conviction capital allocator. The antithesis of this patient, high-conviction approach is the day trader or the hyperactive retail investor. Let's call him Frank. Frank starts his day at 6 a.m., reading pre-market news and scanning social media for the day's hot stock. His desk looks like a command center with multiple monitors displaying charts, news feeds, and his trading platform. When the market opens at 9:30 a.m., he has a flurry of activity. He sees a biotech stock spike on a rumor about a new drug trial, so he buys it, hoping to ride the momentum for a few points. An hour later, he sees an analyst downgrade a tech stock he owns, so he immediately sells it. He uses complex technical indicators like RSI and MACD to make split-second decisions. He is constantly checking his portfolio, feeling the thrill of a small win and the sting of a small loss. By the end of the day, he may have made dozens of trades. Frank feels productive, he feels engaged, he has been busy all day, playing the market. But what is he actually accomplishing? He is mistaking activity for progress. His constant trading incurs significant commission costs. Each small winning trade is a taxable event, chipping away at his capital. He is essentially playing a zero-sum game against high-frequency trading algorithms and seasoned institutional professionals, a game where he has a significant disadvantage. He has no deep understanding of any of the companies he is trading. His decisions are based on fleeting news, rumors, and chart patterns, not on the long-term, fundamental earning power of a business. He is the polar opposite of the 20-slot punch card investor. Frank would use up his entire lifetime's card in a single morning. His approach is a recipe for high stress, high costs, and for the vast majority of people who attempt it, dismal long-term returns. It is the perfect illustration of how an undisciplined temperament, driven by an action bias, can lead to the destruction of capital, completely derailing the path to financial freedom. The direct financial connection of cultivating a patient, decisive temperament is the single most powerful force in all of finance. Uninterrupted compounding. When you find a great business and buy it at a fair price, the most profitable thing you can do is often nothing at all. Every year that you hold the investment without selling, you allow your returns to compound on themselves in a tax-deferred manner. Let's consider a simple example. An investor who achieves a 15% annual return, but, due to hyperactive trading, loses 3% of their capital each year to taxes and transaction costs, is left with a net return of 12%. Another investor who also achieves a 15% return but holds their investments for the long term and rarely sells, gets to keep nearly the full 15%. Over a 30-year period, the difference is not small, it is astronomical. $1 million invested at 12% for 30 years grows to approximately $30 million. That same $1 million invested at 15% grows to over $66 million. The patient investor ends up with more than double the wealth, not because they were a better stock picker, but simply because they had the temperament to get out of their own way and let the power of compounding do its work. This patient approach, born from the 20-slot punch card mindset, directly impacts your asset allocation strategy. It leads to a highly concentrated portfolio, where a few high-conviction ideas make up the bulk of your holdings. This is how real wealth is built, not by diversifying into 100 mediocre ideas, but by making a few carefully selected and significant bets within your circle of competence. This temperament is the final, crucial ingredient. It is the psychological operating system that allows all the other principles, the rejection of complexity, the focus on business reality, the discipline of the circle of competence, and the safety of a margin of safety, to work together to produce extraordinary results. It is the final promise of the Warren Buffett strategy, a path to not only superior financial returns, but to a state of calm, confident, and rational control over your financial destiny. You have just invested a significant amount of your most valuable asset, your time, to fundamentally rewire the way you think about investing. You have pushed past the noise and the complexity that paralyzes 99% of market participants and absorbed a powerful, clarifying mental model. You now possess the blueprint for the one napkin method, a way of thinking that allows you to cut through the fog of false precision and focus on the handful of truths that actually build fortunes. You understand that the goal is not to build the most intricate spreadsheet, but to cultivate the deepest understanding of a business's core reality. This is not just another piece of financial advice. It is a complete intellectual toolkit you can use for the rest of your life to make better, more rational decisions about your capital. But what you've mastered today is a single powerful node in a much larger network of thinking. Warren Buffett's success is not the result of one single trick or mental model. It is the result of an interconnected web of principles, a latticework of ideas that support and reinforce one another. You have just forged a crucial piece of that structure, the ability to simplify and clarify. But how does this connect to the art of identifying a durable competitive advantage, or what he calls a moat? How does the principle of thinking like a business owner influence the way you read a financial statement? The framework you have built today is strong, but it is not yet complete. The video that is about to play on your screen is not an accident. The algorithm has identified it as the next logical step in your journey. It holds a different piece of the map, another critical model from the mind of Buffett and his partners. Think of what you've just learned as the powerful lens of a telescope. The next video is the knowledge of where to point it. It is the link that connects the how to think with the what to look for. It will take the clarifying power of the one napkin method and weaponize it, showing you how to apply it to specific business situations to find those rare, wonderful companies capable of compounding wealth for decades. The choice to click is about more than just watching another video. It is a declaration of your identity. Are you a passive consumer of financial entertainment, or are you a serious architect of your own financial future? The person who is content with a single insight will close this window. The person who is committed to assembling a complete mental arsenal, who understands that each model builds upon the last, will see this next video not as a suggestion, but as a necessity. Continue your ascent. Complete the framework. The next piece of the puzzle is waiting for you. Click and master it.